What's going on? Ryan here. Welcome back. In this video, we're talking about the bid-ask spread. Now, let's pull up this trade tab. We'll bring back Apple again. And remember, these markets are built, they're a place where people come to conduct business and to buy and sell securities, right? There's all different types of assets. But just for this example, we're talking about Apple, right? And we're talking about shares in Apple. And it's important to understand that the underlying asset itself has a bid-ask spread, right? Where the ask is what the sellers are asking to sell one share, right? And the bid is what the buyers are willing to pay, right? So the ask is what the seller wants and the bid is what the buyer is willing to pay. And it's a balance, right? There's a spread, and then what happens is in the system when the buyer and the seller agree and the prices converge, then you have a transaction. Okay, so it's important to understand that not only is there a bid-ask spread for the underlying asset itself, but there's a bid-ask spread on the option prices themselves, right? So again, we can see here's our options chain. I only have, let's bring 25 strikes. So here's 25 strikes, and we have our in the money on the calls. We have our in the money on the puts. Here's our at the money. Here's our out of the money. And we can see that, okay, here is our last price. Here is the net change. And then we have this bid-ask spread, right? So we can see that on this 170 call, right, we have a bid-ask spread where someone is bidding $6.25 to buy, right? They're willing to pay $6.25 for this option. And here is somebody else that is willing to sell that option at $6.50. And important to know, right, that these bid-ask spreads, they're constantly fluctuating. There can be situations arise where the bid-ask spread is highly skewed, right, where there might not even be any buyers or there might not be any sellers, right, where you have like a bid no ask or an ask no bid, okay? Important to understand the bid-ask spread because this is where you can lose money, right? Think about it. If you're buying options and you're getting in at the wrong time, or if you're selling options and you're getting in at not a favorable time, well, then this bid-ask spread can immediately move against you, right? You could buy the option and then it could immediately lose value. You could sell the option and it could move against you, right? Whatever it's going to be, these option prices are sensitive to the underlying price movement. And another thing to understand with this bid-ask spread is that when markets are moving quickly and markets are volatile, right, these bid-ask spreads can become very wide. Like, for instance, if we look at something like Amazon, right, the options on Amazon are very expensive, right? When we look at an option on Amazon, think about this at the money $33.55. The last trading price for this was $110. This is a $110 option times 100 shares of Amazon. This is an $11,000 option. Okay, so if we look at the bid-ask spread on this one right here, the same option, market's closed right now. This is 113.15, right? And that's times 100 shares, right? So this is $11,315, right? Someone is willing to bid for this option. And someone is asking 117, right? So 117.5 times 100, right? So that's that's 11,750, right? So what is that? 715 minus 315, right? So there's a $400 wide price gap here on this bid-ask spread, right? So think about it. I mean, you could come in here and try to buy or sell this option, and then immediately once you put that trade on, just because of the bid-ask spread, your position could either become a winner or a loser, right? Which is why when we start actually looking at trading options and we're making assumptions about the market, right, where the price can go, it's often very lucrative as traders to set up our trades where we're either trying to buy the option below the bid-ask spread, or we're trying to sell the option above the bid-ask spread to potentially protect us from losing money on the spread, right? So this is a huge thing. This is a huge thing to understand, right? Is that you can lose money with options and with trading assets outright purely because of the bid-ask spread. Now, I highly recommend always trading assets and options that are highly liquid, right? The more liquid an option, the more people trading it, the narrower that the bid-ask spread could be, right? On assets like Amazon and Google, though, the bid-ask spreads are known to be wider, right? They're more expensive. And this is something that you really need to understand and be aware of when you're starting to trade. So I know that whether you're already trading or maybe you've never traded at all, this is an important concept to understand because this is one of the places where you're going to lose money if you're not aware. Okay, so just know, again, that assets themselves have bid-ask spread, right? Marketplaces where buyers and sellers are coming together. And again, the options themselves, right? There's buyers and sellers, and again, there's a bid-ask spread. So if you have any questions, reach out to me. Love to hear from you. And I look forward to seeing you in the next video.